Hi guys! In today's episode, I would like to talk about the student loan debt. I have Jason Russell with us. Hey Jason.
Hi, Hadass.
For those of you that didn't get to watch our previous episode, Jason is a loan officer here in Solano County, and he's been doing it over 18 years. So Jason, recently I met a lot of clients who are in their 40s and even in their 50s, and they are still carrying their student loan debt. So I was wondering how much weight you guys as a lender put on this debt. Is it like a car loan debt? Is it like a credit card debt? So if you can please explain us how it works when you guys calculate the debt to income ratio when you try to qualify a buyer.
Sure. I think it would be helpful to define what a debt to income ratio is to begin. So one of the things that we look at as a lender when qualifying someone is what's called a debt to income ratio. And what we do is we measure the amount of income they have coming in every month, and we measure that against the amount of monthly payments they have going out on their credit report each month, and we show that as a percentage. So for example, if someone were to earn $10,000 a month in income before taxes and had $5,000 a month in monthly payments on their credit report, they would have a 50% debt to income ratio. So we want to try and keep that number at 50% or below for most of our loan products. In terms of how we treat student loans, they go into the same pool as anything else that shows up on the credit report, be it a mortgage, a credit card, a student loan, car payments, whatever those monthly payments are that are reflecting on that credit report, we put them into the same pool as far as how the debt to income ratio is calculated.
All right. So with this being said, what is going to happen to those people whose payment are deferred until June due to COVID? Or maybe they're still at school, so they're not really pay yet.
Yeah, it's a great question. And I would say it's actually a very common scenario. Most people that I talk to actually are more likely to have payments deferred than actually making payments. So when those payments are deferred, when we see the credit report, the monthly payment shows as $0. So what our loan requirements have for us and require that we do is that we basically create a hypothetical payment based on the loan balance. So I'll share my screen with you here briefly so you can see. Of course, it will depend on the specific loan type and the scenario, but in most cases, for folks who are looking to do a conventional or an FHA loan, if those student loans are deferred, we are required to take 0.5% of their loan payment, of their loan balance, as a hypothetical monthly payment. So for example, if someone has $10,000 in student loans, 0.5% of that is a $50 monthly payment that's hypothetical that goes into their qualifying figures. Now, again, if they are making their payments normally and they're not in deferment, we just use that payment that shows up on the credit report. But in the event that they are in deferment, be it for COVID or the fact that they're still in school, we would at that point use 0.5% of whatever the total balance of the student loans are and use that as a hypothetical payment.
Okay, so what happened when they need to start paying this payment?
Yeah, well, and what's happening for a lot of folks right now is their payments, their student loan payments have been deferred due to COVID, and that keeps getting extended further and further out. Right now, that's deferred into the end of June. So at the end of June, if there are no further extensions, at that point, we would just factor in whatever the payment is that once they enter in a normal repayment plan. So they might have an income-based repayment plan, they might have a normal payment plan. Whatever that specific payment plan is, it will update onto the credit report, and we would then use whatever that number is.
Okay, so basically it depends when they gonna get the loan, the timing. It's all about the timing.
Oh, yeah, it's great. Yeah, so that's a great point. So in the event someone is looking to buy before June, and in this example, then we would use that 0.5% factor as a calculation number. In the event that they're buying after June, when they're making their normal payments, at that point, we would use whatever those normal payments are for qualifying.
Yes. Well, makes sense. Well, thank you so much for explaining a little bit about it. You make it more clear. And I appreciate your time. And I want to wish everyone Merry Christmas and Happy Hanukkah and Happy New Year. So Jason, we see you after New Year, right?
Awesome. Looking forward to it.
Okay, thank you so much. You guys take care. Bye-bye.